Afternoon, everybody. Ryan, I'm looking right at you. Can you hear me? Give me a little wave if you can hear me. I can't hear you, though, Brian.
There we go. Yep, I can hear you.
Good. My name is Don Johnston. I'm a partner at Tax Services Group, Grossman, Yannick & Ford. Welcome to our CPE Day, 2 hours of tax CPE. I want to introduce my lovely speaker, Ryan Fronius. Ryan is a manager in our Tax Services Group, and he will be presenting along with me today. Welcome, Ryan.
Thank you. Thank you, everyone, for being here.
So initially, the plan was Ryan and I were going to be sitting across from each other so we can, work off of each other, bounce some questions off of each other as we go through the presentation. Unfortunately, because of the rules that came out just yesterday, we're not allowed to be in the same conference room unless we have masks on, and we certainly didn't want to present with masks on. So we are in the same building, 3 Gateway Center. I come to you from conference room 1. Ryan is in conference room 3. We are close to each other, but not so close where we can contaminate each other if either one of us has an issue. Well, wanted to thank everybody for attending. At this point, at this part, we've got 303 people listening in attentively, trying to understand what Don's going to talk about this year with respect to the current tax law update. I've been with the firm for 26 years. Throughout those 26 years, I've probably done a current tax update probably at least 20 of those years. As we get to CPE Day every year, I kind of just grab that because it's something that I like talking about. I like giving the update every year. And like I said, I've probably done it 20 years in a row with respect to current tax update. The toughest years for me are the years that are election years. Anybody who was at CPE Day 4 years ago when the election results were completely different than what the poll said, they remember how difficult and how much I cried, actually, with respect to having to present on that particular topic, because in no way did we anticipate that President Donald Trump was going to take over the presidency. So we planned the entire tax update around the fact that we would have Hillary Clinton as president, not Donald Trump. So everything had to be changed about 24 hours before the presentation. This year, knowing that we were going to do everything electronically, and we're going to spread our CPE Day over 5 weeks, I made sure that I did not take the slot to do this tax update right after the election, 2 days after the election, because we had no idea what was going to happen, nor could we estimate what kind of tax changes we would be able to project going into 2021. Well, we're 2.5 weeks past that date, and we still don't know. So, some of the things we'll talk about today, some of the things that I will address, will be based upon two different things with respect to the outcome of potential elections that still haven't been decided yet, and I'll dig into that a little bit. So, the general outline for the day, which we'll go through, both Ryan and I. First, the tax law. I'll talk a little bit about the tax law with respect to 2020 and then 2021, what to expect under potentially a President-elect Biden and his tax position. Talk a little bit about the CARES Act. CARES Act passed in March of 2020. Everybody is aware that the CARES Act was passed, but we'll address some of the more important things. Talk about the Paycheck Protection Program a little bit. Bob and Michael talked about that at last week's presentation, so I'll spend just a little bit of time talking about it. I won't talk at all about application for forgiveness or anything like that. Just talk mainly about tax consequences associated with the Paycheck Protection Program. Then I'll talk a little bit about business tax changes from the CARES Act and some business things that we've seen since the CARES Act was passed. Ryan will pick it up, talk about some individual tax changes. We'll also throw in some other things here and there, and then we'll throw in some year-end tax planning considerations at the end. So post-election, we say post-election, but it really isn't post-election, right? I mean, we still have some things going on, but we're trying to figure out from a tax point of view what we should be thinking about, for the remainder of 2020. We're not expecting that there are going to be any significant tax law changes between now and the end of the year, except for the potential that the PPP loan, there could be PPP loan guidance that comes out, because there's still a question with respect to whether the PPP loan is going to be taxable. The way that the current tax law is written, the way the IRS has interpreted the law, the PPP loan is taxable. But our understanding, based upon what we've heard through going to different sessions, different CPE sessions, paying attention to what's going on in Washington, we think there's a reasonable chance that Congress will change the taxability of the PPP, and I'll talk a little bit about that. With respect to 2021, and specifically talking about tax issues, 2021, when we look into 2021, what do we expect with respect to tax law? You know, what's going to change with respect to tax law? How do we plan for 2020, knowing what potentially could happen in 2021? Well, in reality, the fate of the tax law rests with the Senate. Assuming that, well, we know that the Democrats control the House, and assuming that the presidency is not going to change from what's already been discussed and released, i.e., we have President-elect Biden stepping into the White House. The question is, who controls the Senate? Because the difference between the Republicans controlling the Senate in 2021 and the Democrats controlling the Senate in 2021 make a significant difference with respect to tax law changes that may or may not occur in 2021. So where are we right now? Right now, as far as what's been settled, there are 48 Democrat senators. There are 50 Republican senators. 2 spots remain open. Those 2 spots are the 2 Georgia spots. So the entire fate of 21 tax law comes down to the Senate race in Georgia. So why is Georgia still open? Why has that not been settled yet? Well, the main reason is because Georgia, the state of Georgia, requires a senator to obtain at least 50% or more of the votes to become a senator. Both of the incumbent Republicans did not get more than 50% of the vote during the November election, so there has to be a runoff. That runoff, unfortunately, doesn't occur until January of 2021. So where we sit right now is we don't know the fate of the Senate because the 2 Georgia seats have not technically been filled yet. So, you know, if the Democrats have 50% or have 50 wins right now, 50 seats already claimed, they need 1 more seat away so they can control the Senate going forward into 2021. So they need to win 1 out of 2 seats to control the Senate. The Democrats need to win both of those seats. If the Democrats win both of those seats, the Senate would be tied. It'd be 50 Democrats, 50 Republicans. And when there's a tie, the vice president is the breaking vote. So if the Democrats win those 2 Georgia seats, the Democrats will control the Senate via the tie-breaking vote from the vice president, assuming that would be Kamala Harris. So why is that important? Well, it's very important because if the Republicans maintain control of the Senate going forward into 2021, it's going to be very difficult for President-elect Biden to get his tax law changes through Congress. What we would envision is, you know, since the House is still controlled by the Democrats, they would probably propose tax law changes, probably in line with what President Biden wants. But once it gets to the Senate, it would probably be shot down via votes by the Republicans to shoot it down, meaning that unless there is a defector from the Republican side of the Senate, major tax law changes are probably not going to happen. And if the Republicans take that Georgia seat, it probably means for the next 2 years, there would probably not be significant tax law changes, at least not tax law changes that were, you know, extreme. We heard during the election, President Biden's thoughts on tax law changes going forward. He had a lot of changes to the tax law, but those changes most likely are not going to happen if the Republicans control the Senate. So, you know, that's the reason the box is blank there, is because there may be a whole lot of nothing over the next 2 years with respect to significant tax law changes, depending upon who wins that last seat in Georgia. On the other hand, if the Democrats take both of those seats in Georgia, there is a very good chance that there would be significant tax law changes in 2021. Now, obviously, the pandemic has an effect on how soon and how significant these tax law changes will be. But if the Democratic Party controls the House, the Senate, and the White House, you can pretty much guarantee that there are going to be significant tax law changes going into effect at some point in 2021 or 2022. So like I said earlier, the future of the tax law changes. The future of what's going to happen in 2021 comes down effectively to Georgia and what happens with those 2 Senate seats in Georgia. Like I said, 1 seat won by the Republicans means they have control. 2 seats won by Democrats mean they have control. So it all comes down to that that runoff, which doesn't happen, conveniently doesn't happen until January 5th of 2021, which completely changes how we do year-end tax planning, knowing that we really don't know what the potential changes will be in 2021 because the election hasn't happened yet. So just let me run through just briefly what President-elect Biden and his plan was. And these are promises. When I say promises, these are things that came out during the election. Now, knowing that, that doesn't mean he's necessarily, if he has the ability to, doesn't mean he's going to make all of these changes or any of these changes, and all these numbers could be completely different, you know, once his proposals go through and once it runs through the House and then the Senate and then to the White House to his desk for signature. So he would raise taxes on individuals, and you know, you heard him say, I mean, he was on TV. You saw his political ads. Anybody making over $400,000 would have a tax rate increase, so they'd be paying more taxes. And he also talked about raising the income tax rate on higher wealth individuals on capital gains. From what I have been able to see, that additional capital gains tax, or the higher rate of capital gains, wouldn't happen until taxable income was over $1 million. At least that's what I've seen so far. He also talked about changing the itemized deductions and limiting it to a certain threshold for folks making over $400,000. Temporarily increasing the child credit and the dependent credit. A couple other things: repeal of some of the Tax Cuts and Jobs Act components for high income tax filers. He would impose an additional Social Security tax on wages above $400,000. Now, my understanding of that is if you're an employee, the employee pays a portion of it, the employer pays a portion of it. At least that's my interpretation of what he means when he says that. Corporate rate would increase from 21 to 28%, and there would be a significant change to the federal estate tax exclusion, which would come down to $3.5 million, all the way down from where it is now of about $11.5 million. So effectively, you know, a lot of President Trump's tax cuts would be changed under the Biden administration, assuming that he has control of the Senate. So the question is, how do you plan when you don't know what the Senate's, you know, the Senate control is still up in the air? How do you plan in 2020 when you don't know what the answer is in 2021? And it's always hard to do year-end tax planning, but it's even more difficult when there's so many questions in the air with respect to what's going to happen in 2021. One thing we know for sure, and I would pretty much bet the mortgage on it, is tax rates are not going to go down anytime soon, right? Even in the best case scenario, I can't imagine that tax rates are going to go down for most Americans. Part of the reason is because we have a Democrat in the White House. They're trying to reverse a lot of the Trump tax cuts, and the budget deficit is completely out of control, especially with a lot of the money that was given away because of COVID-19. So a couple questions come up. Should income be accelerated to 2020? If we know that the tax rates are not going to come down from where they are, does it make sense to accelerate taxable income into 2020? If we know that the tax rates are going up, does it make sense to defer deductions to 2021? Because if the tax rate next year is 10 percentage points higher than it is this year, both of those things, the answer would probably be yes, depending upon the situation. Next question, should capital gains be accelerated into 2020 instead of 2021? Well, again, if you make over $1 million or you expect a large taxable income year in 2020, it may make sense to accelerate capital gains into 2020 instead of deferring them to 2021. Now, throughout my career, there have been many situations where we're doing tax planning. It is rare where we're talking like this, where it's rare where we're saying, oh, we should accelerate income into this particular tax year. Sometimes it happens depending upon where the tax law is, but it's pretty rare. I think this is one of those rare situations where it's very possible that this is the year that we really have to sit back and think whether we should be, moving taxable income into 2020 as opposed to deferring until 2021. But a lot of that, like I said, depends upon what happens in Georgia with the final Senate seat. And then what about estate planning under the Biden administration? Estate planning, obviously very complex, and most people don't have to do estate planning. People who do estate planning have high net worth. The current exemption is $11.5 million per person, or approximately $23 million for a married couple. What that means is, if you pass away, if two joint couple both pass away and they have $23 million estate, they don't pay any estate tax because there's a $23 million exemption. Under the proposed rules under the Biden administration, that exemption would be reduced to $3.5 million per person, or $7 million combined. So we're talking about a $16 million of the exemption disappearing. Now the $11.5 million is set to expire at the end of 2025. So a lot of estate planning attorneys have been planning for that, knowing that 2025 is basically D-Day with respect to the revision of the exemption back to $7 million. But it is possible that that exemption gets reduced as early as 2021, depending upon what happens with the Georgia race. We have a lot of contacts and attorneys that we work with that do estate planning, and they are just being bombarded right now, obviously with their wealthier clients where this is a significant issue. So let's move to polling question number 1, and I'll let Carissa take over and do polling question number 1. And obviously you can see that question relates to year-end tax planning, knowing that the Senate is still up in the air. Okay, so I think the polling question has been answered. It's disappeared off my screen. So let's move to the tax bill that was passed in March of 2020, the CARES Act. This was a gigantic tax package. Everybody knows why the CARES Act was passed. So we're going to spend a little bit of time first talking about the business aspects of the CARES Act, and then Ryan will talk about the individual aspects of the CARES Act, knowing that, I mean, this was a huge tax bill, so with stuff that we've never seen before, stuff that took many months to decipher and figure out exactly where we were going with some of the stuff. The biggest thing out there under the CARES Act was the Paycheck Protection Program loans. Early on, when the CARES Act was passed, everybody was scrambling trying to figure out whether they should apply for PPP loans, whether they were eligible to apply for PPP loans. And at the end of the day, we were telling clients that everybody should consider it. And unless you were a company that you were sure was not going to be affected by coronavirus, you should probably apply for PPP. We did a lot of work with respect to PPP in March and April, and a lot of our clients were eligible and received PPP loans. So when Congress passed the CARES Act, the general thought was the money received through the PPP program was not taxable income. But the problem is the way the IRS and Treasury interpreted the law, which was the right answer. I mean, it is the right answer. The expenses paid with funds that were received from the PPP loans are not deductible, which effectively means that the PPP loans are taxable income. And they comes in the back door, but it's still taxable income. So as we get close to year end, that's something that as tax preparers and tax planners, we need to be considering that. Because if somebody sends me a trial balance and says, hey, we're break even this year, we don't have any taxable income, so we don't have to pay any estimated tax payments. But if they are deducting the expenses that were paid by the PPP loans, then they've got a completely different answer. Because if they thought they were break even, but they received $1 million PPP loan, they have $1 million of potential taxable income. So that's something that needs to be considered, because it could produce a very different tax consequence as opposed to thinking that, or as opposed to not including that PPP money in taxable income. Second question here is, what tax year is it taxable? There was a lot of discussion over the last couple of months about when the PPP money would be included in taxable income. Just last night, Treasury and IRS issued guidance on that very issue. You can see the tax alert that Bob Grossman posted on our website earlier today. The Treasury and IRS came out and basically said that if you're anticipating, or if you reasonably believe that the PPP money is going to be forgiven, then that you have to exclude those deductions in 2020. It's not a 2021 issue. If you reasonably believe you're not going to have to pay that loan back, then the PPP receipt is taxable in 2020. You do not get to defer it until 2021. And like I said, that just came out last night, so that information is hot off the press. We are expecting future guidance, but that guidance we're expecting hopefully deals with whether it is actually taxable income or not. At one point, Congress came out and was talking about the fact that they did not anticipate that this would be included in taxable income. So because of that, there's been a lot of question. The election and coronavirus pretty much has distracted Congress from a lot of other things that are important, and this is one of those things. We cannot tell you whether Congress is going to change that as far as the PPP being taxable or not. We think there's a pretty good chance that we're going to see something before the end of the year that either clarifies that that's not taxable income. Next point on here is, should you be concerned if your PPP loan is over $2 million? You know what? That's a good question. I wrote the question, so obviously it's a good question. The question is, should you be concerned? Well, yes, depending upon your situation, you should be concerned. If you're a company that has struggled big time as a result of coronavirus, if you're a company that had $10 million of revenue last year, but in 2020, your revenue was $5 million, and your profitability has basically diminished, and you're struggling to keep the lights on, then you shouldn't have a problem. But if you're a company that had $10 million of revenue last year, and you have $10 million of revenue this year, you have sufficient cash flow, and you had sufficient cash flow in the bank, and other circumstances point to the fact that you may not have needed the money, then there is a level of concern that you should at least consider. A couple weeks ago, November 11th, the SBA put out the Paycheck Protection Program Loan Necessity Questionnaire for for-profit borrowers. This document is 9 pages long, and it goes through a series of questions that any company that has a PPP loan of over $2 million is going to have to respond to and answer. Right now, this is still in draft form. My understanding is once it goes in the final form, you'll get this document from your bank, and you have 10 days to complete the document and get it back to the bank. Just going through a couple of the questions, I'm not going to go through the whole thing. There's a link to this on our website, but just going through a couple of the questions. Question number 1, what was your gross revenue in the second quarter of 2020? Next question, what was your gross revenue in the second quarter of 2019? They're looking at your comparison of your revenue. A couple other questions. Question number 2 talks about whether you've been ordered to shut down by a state or local authority. Question number 3, have you altered your operations because of COVID, or were you required to alter your operations because of COVID, or because of a state or government requirement? Did you voluntarily alter your operation? Did you have any new capital improvement projects that were not related to COVID-19? So I think if you're in a situation where you did a $10 million expansion and it had nothing to do with COVID, and you paid for that with cash flow, what do you want me to do? I think we lost our sound. Ryan, can you hear me?
Yeah, I can hear you fine, dog.
Okay. So I'm assuming everybody can hear me because someone just walked in and said they can hear me. I'm going to continue on, assuming everybody can hear me. So moving on with the loan necessity form. If your loan is over $2 million, you should take a look at this form, because eventually your bank is going to send this form to you, and you're going to have to answer the questions. The last thing I'm going to mention on PPP loans is if there's an ownership change in a company that has a PPP loan, it is very important for the buyer to understand that that PPP loan is out there. For example, I had a transaction that closed on October 1st, and the seller had a PPP loan of $300,000. The buyer bought the S corporation stock. And we know that based upon the current law, that $300,000 of PPP loan is going to produce taxable income at some point. So in that situation, it's critical as the buyer that first, I know that PPP loan is going to create taxable income. And it's also critical that I address that in my stock purchase agreement. If I'm buying the stock of that company, I don't want to step into a situation where I buy the stock and I have a $300,000 of taxable income that I didn't anticipate or I didn't expect. So it's very important to understand whether a company has a PPP loan if you're going to acquire that company. It's critical to understand that. And we've had at least 2 or 3 situations where we specifically changed in those cases, stock purchase agreement to account for the PPP loan, knowing that it's out there and knowing that it's going to produce taxable income in the future. Okay, let's move off of PPP loans, talk about the employee retention credit. And again, still sticking with business-related changes under the CARES Act, the employee retention credit is out there. We've had very few clients that would use this because most of our clients qualified for and got PPP loans. If you have a PPP loan, you're not going to use the employee retention credit. The employee retention credit is a credit that's out there for employers for keeping and maintaining their employees. There's a credit of up to $5,000 per employee, and it's based upon 50% of the wages you pay them during that period, 3/12/20 to January 1st of 2021. So basically, it's a credit for keeping your employees and maintaining operations. And companies that have more than 500 employees are eligible for this. And I'm not going to go into a whole lot of detail here because, like I said, it only applies to probably a handful of people on the call. But just know that credit is out there, and it's very important if you didn't qualify for the PPP loan. I'm going to skip the economic injury disaster loan. If you have that loan, you can check out the information here. I wanted to have it on the slide just in case you have an EIDL loan, if you're qualified for one, but I'm going to skip it. I'm going to talk about this. I think this is an important issue. It's the FICA tax deferral. So basically, as a result of COVID, businesses are permitted to defer their payment of FICA taxes. So the employer portion of the FICA tax is 6.2%. So basically, for every employee you have, you pay FICA tax of 6.2%, which is the employer portion of the FICA. Under the CARES Act, you can defer that payment. So you don't have to make that payment until the end of December 31st, 2021 and 2022. So let me give you an example. If you have 100 employees, you pay 100 employees $50,000 a year, the total FICA tax that you would collect over that year would be $310,000. Actually, you're not collecting it. The total tax you would pay, because it's an employer tax, the total tax would be $310,000. Instead of paying that as part of your payroll taxes, you can defer half of it until December 31st of 2021, the other half until the end of December 31st, 2022. You still have to pay it, you just don't have to pay it, until the end of those tax years. So it's something you'd have to accrue for at the end of the year, but it could free up cash flow if you're in a cash flow crunch. And that deferral was effective for salaries paid from March 27th, 2020 through January 1st, 2021. A couple other considerations before we get over to the individual side. The expansion of net operating losses. Under the CARES Act, you're now allowed to carry net operating losses back 5 years, and those are applicable for tax years 2018, 2019, and 2020. So we had a lot of clients where we were able to go back to tax years 2018 and carry losses back 5 years and get a lot of money back. Just a handful of our clients, we were able to get PPP loans of somewhere between $500,000 and $1 million, which helped operations, obviously. And then we were able to carry some of the losses back, completely unrelated to PPP. We were able to carry some of the losses back 5 years and get a couple $1 million of taxes back that were paid in prior years. So that's been incredibly important for many of our manufacturers who have struggled over the last couple of years and had net operating losses. So anybody who has corporate net operating losses, need to be reaching out to us to make sure that we're carrying those losses back. There's a slight, I'm going to skip over a couple of these real quick. Slight change to business interest under Section 163J. They changed the limitation to 50% from 30%. So that's for any companies that have significant amount of debt, and there are limitations on the amount of interest expense that you can deduct. And then the last thing is the acceleration of minimum tax credit. And basically for corporations, basically eliminated AMT. The AMT was set to be refunded over the next couple years under the Tax Cuts and Jobs Act. This change in the CARES Act just accelerated the minimum tax credit and basically eliminated AMT. So when we did a lot of the NOLs, NOL carrybacks, what was happening is we'd carry back to tax year 2014, and there would be an AMT issue in 2014, which would carry forward to 2018, and then we were able to get that refund in 2018, as opposed to waiting until 2021 or 2022 to get those refunds back. So let's go to polling question number 2. Chris, are you still awake?
Absolutely, Don. Alive and well out here.
So this polling question is asking which of the business-related CARES Act provisions was most useful to your business. And like I said, for my clients, I would say question or item D here is the right answer, because we had a lot of clients that benefited from PPP loans. We had a lot of clients benefited from the carryback of net operating losses. Like I said, it freed up significant cash flow for a lot of our clients. And I see the polling question is off the screen, so I'm going to reintroduce Ryan Fronius. Ryan's going to talk about individual tax changes with respect to the CARES Act. Mr. Fronius, you're up.
All right, thank you, Dawn. As Dawn mentioned, I'll be covering the individual taxpayer changes that are part of the CARES Act. And the first thing I want to talk about are the economic income payments. You might know these better as the stimulus checks that were sent out earlier in the year with the purpose of helping to reduce the financial burden of COVID-19. These were automatic payments for most taxpayers where no action was needed by the taxpayer. No action was needed by any taxpayers who filed their 2018 or 2019 returns, and this included most seniors or people who were retired. These payments were $1,200 per individual, or if married filing jointly, $2,400, plus an additional $500 per qualifying child. While there's no minimum income required to receive these payments, there are income limits that are imposed as your income rises. So it starts being phased out when your adjusted gross income is between $75,000 and $99,000 if you're single. And you can see in the bracket to the right of that the different phase-out ranges of married filing jointly. Now, once they get over certain amounts, so once they're over $99,000, if you're single or if you're married filing jointly over $198,000, there's no payment at all. You're also ineligible to receive a payment if you were claimed as a dependent on another taxpayer's return. That being a dependent would preclude you from getting those payments. Now, what happens if you don't file a tax return? If you're not required to file a tax return and you haven't received payment, there's a deadline coming up shortly, November 21st, that you have to request those payments. And we provided a link on these slides that you can go to, enter some information that'll help you to get your payment. And again, that is if you don't normally file a tax return. Now, at this point, we're getting towards the end of the year, so if you haven't received your payment in 2020, then you can claim it at the latest on your 2020 tax return. So if you haven't gotten it yet, you'll be able to claim it somehow on your 2020 tax return. Now, what if I haven't filed my 2018 or 2019 tax returns? A lot of the guidance that's out there is really showing that the amount of payment that you're allowed to receive is based on either your 2018 or your 2019 tax returns. If you haven't filed 2019, it uses your 2018 returns, but what if you haven't filed 18? Well, unfortunately, there's not a whole lot of guidance on that. The IRS gives a vague answer and just strongly insists on filing those returns as soon as possible to receive payment. But again, the fact that you'll be able to get it on your 2020 return at the latest, that shouldn't be an issue. You want to file those returns very soon, obviously, but you should be able to get it on your 2020 tax return. Again, some more on the economic impact payments. There's been some talk about whether or not there's going to be a second round of these payments. We're not real sure at this point. It does seem likely that there will be a second round. In fact, it's one of the few things lately that Republicans and Democrats have been able to agree on, is that there is a need for a second round of payments. The disagreements that the two parties have are the size of the stimulus package and the amount of the payments. So while the timing is uncertain, it's unlikely that it will happen in 2020 at this point. If they do happen, it'll likely be 2021. Moving away from the economic impact payments towards the qualified retirement plans and IRAs, we'll talk about some of the things that were covered in the CARES Act in these two sections. So the first thing is the required minimum distributions. Under the CARES Act, these requirements were actually waived for 2020. So for 2020, you did not have to take a required minimum distribution. However, if you did previously take a required minimum distribution in the year before all of this came out, you had until August 31st, 2020 to roll back those funds into your plan. So basically you had until August 31st to repay those. To the extent that you did repay them into your plan, they would be excluded from taxable income. However, if you didn't repay them and you kept the required minimum distributions, those would still be included as in your taxable income like they would in any other year. It's important to note these repayments are not subject to the one rollover per 12-month period limitation, meaning these aren't going to hinder you from rolling over other IRAs. And with the RMDs, there's no coronavirus eligibility requirement, so this does apply to everyone. The other area is the coronavirus-related distributions, or CRDs. In these, which we'll get into, I believe, on the next slide, there are actual, as the name would imply, restrictions related to COVID-19. These CRDs allow for withdrawals from the plans of up to $100,000. This includes 401k, 403b, and IRAs. These distributions are not subject to tax withholding requirements or the 10% early withdrawal penalty. So you don't have to have tax withheld, and you're not going to get hit with a 10% early withdrawal penalty. These are repayable at any time during a 3-year period starting the day after the distribution is received, and they're taxable ratably over 3 years. Now, as I mentioned before, the CRDs do have certain COVID-related restrictions, meaning that only certain qualified individuals can receive these. Qualified individuals, anyone that's diagnosed with COVID-19, including a spouse or dependent, or anyone who experiences adverse financial consequences resulting from being quarantined, furloughed, or laid off due to COVID-19, having your work hours reduced, or not being able to work due to lack of child care from COVID-19. So basically, anyone who's really impacted by COVID-19 is able to qualify for these CRDs. And that even includes, say that your spouse has been laid off because of COVID, but you're still going strong, your business is still doing good, you can still take a CRD from your account if your spouse has been affected from that. Moving on, other individual taxpayer changes, let's move on to the deferral of the employee Social Security tax. Dawn talked about the deferral of the employer side of the Social Security tax, but there's also an option which allows for the deferral of the employee Social Security tax. Now, this is not mandatory and it's still up to the employer to allow for this deferral. Now, going a little bit out of order here, this applies to wages that are paid during the period from September 1st, 2020 through the end of 2020. And sorry, getting a little sidetracked. These taxes are deferred from those wages, but the important thing to point out, being that it's a deferral, it's not permanent. It's just a deferral until, you'll see the dates on there, January 21st through the April 21st is when you have to have those Social Security tax paid and withheld. So you might be able to defer them for the end of the year, but you're still going to have those withheld during the first 4 months of 2021. This deferral is applicable for employees with biweekly pre-tax pay of less than $4,000, and that limitation on an annualized basis ends up coming out to $104,000 of wages. Being that it's just a deferral, we're finding that a lot of our clients aren't actually participating in this because it's more of an administrative burden to, mess with the employee's pay just to allow them to have a little bit of more take-home pay, just to have to turn around and repay that a couple months later. Perhaps if it were a permanent deduction, meaning they didn't have to pay those taxes at all, more people would participate in that.
Yeah, so let me make a quick comment there. One of the reasons the employers didn't want to participate in this because there was no guidance that basically allowed them an out if, for example, they deferred somebody's payroll taxes or they deferred their FICA taxes, and then that employee basically just fell off the face of the earth at the end of the year and they didn't come back in January. And there was no way to collect that tax at that point. So, that was definitely a concern for some of the employers. They didn't want to be on the hook should that person fall off the face of the earth and not be able to repay that.
Yeah, very good point, Don. Moving on to some other considerations. Let's talk about self-employed individuals. They also can defer their portion of the self-employment taxes, and that includes even those self-employed individuals that have had PPP loans forgiven. They can defer the payment of 50% of the Social Security tax that's imposed under Section 1401A, and that's for self-employment income for the period beginning March 27, 2020 through the end of 2020. Now, it's important to note that this applies to the employer portion, the 6.2% employer portion of the Social Security tax. So unlike the employee portion that we just talked about that's limited to $4,000 biweekly pre-tax pay, there is no limit on this because, again, it's the employer portion. And then for net operating losses, these also apply to individuals as well as corporations that Don talked about. And these are also, you're able to carry these back 5 years as well.
So Ryan, just a follow-up question on those net operating losses. When would an individual have a net operating loss? What would a situation be?
So an individual has a net operating loss when it has to be business related. So if you're a sole proprietor with a Schedule C, you're a partner in a partnership, and you get a Schedule K1 with business income passed through you, that's whenever the net operating losses come into play. So whenever your business losses from your Schedule C or your Schedule K1 are high enough to offset the other taxable income on your tax return, that's when you would have a net operating loss to carry back.
So you could have a situation where you have a $100,000 loss from a partnership, but you have $200,000 of W-2 income. That does not create a net operating loss. There's no net operating loss to carry back there.
Correct, because it's based on, we'll call it your net income, your net loss. In Don's situation, they just mentioned you would still have net income on your tax return. Now, if your loss was $300,000, you would have a $100,000 net operating loss, being able to carry that back.
Good answer. I have Mary Lou just sent me a question that somebody just asked. Did someone ask you to speculate where you think revenue will be found to pay for COVID relief, corporate estate payroll, et cetera? So basically they're asking, what taxes are going to have to change to pay to dig us out of the budget deficit? I would say all of them. That would be my guess, because it's such a big hole that we're in. So many trillions of dollars were handed out because of coronavirus, and rightfully so. And a lot of those dollars that were handed out did great things for businesses to keep them moving. I would tell you that from our experience, a lot of our clients were in basically just ready to lay a bunch of people off before the PPP loans came out. And looking back now, what I see from a lot of our businesses, a lot of our clients, they ended up actually doing okay. By keeping the business open and continuing to manufacture product or distribute a product. A lot of them turned it around in a pretty meaningful way, and they were able to stay open because of the PPP loans. All right, Carissa, you're up. Polling question number 3. Ooh, a Steelers question. Ooh, that's a harsh question. The Steelers will go undefeated. The Steelers will get a bye in the first round, but lose to the Patriots in the first game of the playoffs, or they'll make it to the Super Bowl and lose to Tom Brady. Okay, so let's briefly talk about some year-end tax planning considerations. We're running out of time, so we only have a couple minutes left. So critical considerations as we look at the end of 2020 and into 2021. Critical considerations. 1, take care in making sure you're getting the PPP loan forgiveness application completed correctly, accurately, get the information to the bank. From what we understand, most of the banks, their portals are really set up well, so it's easy to follow. Most of my clients we've talked to who have applied for the PPP loan through the bank portals have been fairly satisfied with how easy it's been. At least that's with some of the bigger banks. The other thing with relating to PPP, if you use a 24-week covered period and you were open for most of the 24 weeks, it's pretty hard for you to not have 100% of your loan forgiven. I know there are rules with respect to reducing salary, and most of my clients didn't do that. There are also rules with respect to reducing your full-time equivalents. But the fact that you have 24 weeks to spend the money over the covered period really means that you can spend 3 times more money and still qualify for full forgiveness. So most of my clients, almost all of my clients, are getting 100% forgiveness. And the main reason for that has nothing to do other than the fact that they have 24 weeks of costs to put into their PPP application. And certainly contact us if you need help with your PPP applications. We've spent a lot of time on PPP over the last 6 months. Other critical considerations for year-end tax planning, like I said a little bit earlier, timing the recognition of taxable income and deductions can be critical as a result of the potential tax rate increases in the future. Like I said in one of my slides, tax rates aren't going down anytime soon. So, if you know what the tax rates are in 2020, so that tells you let's be thinking about what to do in 2020, and maybe in some cases it makes sense to accelerate income into 2020. I also addressed this earlier, the non-taxability of PPP loans. If Congress comes out over the next month or over the next couple months and says those PPP loans are not taxable income, that has a significant impact on your 2020 tax position. Because, like I said earlier, where we sit right now, if you had $1 million PPP loan, that's $1 million of taxable income in 2020. If that goes away, that potentially frees the company up to carry tax losses back and get money from prior years, to get taxes that were previously paid in another tax year. Year-end capital improvements should be carefully considered. Generally, when we're looking at year-end tax planning, we're telling you, go out and buy a bunch of fixed assets so you can get the bonus depreciation. Well, that still might be the right answer, because if you get that bonus depreciation, you create a big tax loss, you take that tax loss, carry it back 5 years, you might have been paying taxes 34% back then. So that might be a big refund and frees you up, frees that cash flow up for operational purposes moving forward. Alternatively, depending upon your situation, deferral of your fixed asset additions may be the right answer for you. You know, if you know you're going to have big taxable years in 2021 and forward, maybe you want to save those deductions for years in the future where you're going to be in a high tax bracket. Don't forget to contribute to your retirement plans. That's always year-end tax planning. Year-end tax planning 101. Make sure you're putting money into your retirement plan. And generally we tell clients not to try to play the market. And then defer state and local tax payments until 2021. If you have any tax payments due, state and local tax payments that are due, you probably don't want to pay them in 2020. And most people are not getting tax deductions for those in 2020. But there's a chance with a Democratic-run Congress and White House that the SALT rules are going to change. That's probably one of the first things they'll change in 2021 are the SALT rules. So it increases the amount of your state and local taxes on your Schedule A. So I am out of time. Ryan and I are out of time. Thank you, Ryan, for your service. Thank you for your time. Thank you for everybody for attending. We're going to start the next session in about 6 minutes. The next session, we're going to be talking about other tax savings opportunities, some non-traditional tax savings opportunities and credits. We'll see you in a couple minutes. Thank you for attending.